Well, first of all, you're all really welcome. I know it's not exactly the most enticing subject to come to of a Wednesday night, but I really enjoyed putting this course together for all of you. I'm incredibly passionate about tax. I am a bookkeeper and payroll by trade. It's my bread and butter. I'm second generation. And recently I've really gotten into training. I'm a tax technician by trade also. And I love to train people. I think that everyone needs to know the bare bones about tax. It's everyone's business, as I say, to know your business and not rely on an accountant to come along 12 months after the fact and tell you something that you should have known beforehand. Okay, so first things first, this is VAT and income tax 101. This is the bare bones of tax that you really need to know for your business, because you are business people. You know, it's no joke what you do. It's really important, and I'm passionate about making you understand how important your business is. It's really important that you see this. It's not designed to replace the role of an accountant. So, I mean, go for it. If you feel after this that you are well able to do your own tax returns, totally your own decision. But I'm not here to replace an accountant or a tax agent. So always seek advice if you're ever unsure. Also, feel free to contact Revenue. They're not as frightening as people think, and they're very happy to help. You know, that's their job. They're not there just to catch you out for things, and they will guide you if you have any questions. And, you know, like I said, this is what I'm passionate about. So hopefully you can take something from tonight, and I'm going to go through it now as slowly as I can. But Steve, I think, is going to be recording this and releasing it in due course. So don't worry about scribbling notes, because some of the slides are quite content intensive. So don't feel you have to get every single bit of information into your head. Okay, so a little bit of background, as I said, about myself. I have been operating as a self-employed person in bookkeeping and payroll for 20 years. I then went on to study taxes. I'm quite passionate about it. So I'm a tax technician by trade. And it's this year I've set up the sister company to my Burdy Bookkeeping and Payroll Lemoning, which will specialize in offering tax courses to regular people, laying out the bare bones of tax in layman's terms, because I really believe everyone needs to know tax. And personally, anything I've been on that's tax orientated speaks in very complex terms and assumes everyone has a tax background, which I know is not the case. So hopefully you'll enjoy the slides I've put together. I did it with you in mind, so I hope there's not too many puns thrown in there. Steve will slap me on the hand if that's the case. So this is the biggest question we all want to know. Why should I register for income tax? What's in it for me? And as I say, it's really simple as this. If you sell your honey, if you sell your candles, if you sell anything, you are a taxable person. If you take money for anything, you are legally obliged to register for income tax, or at the very least declare that income at the end of the year. Doesn't mean you have an income tax bill necessarily, but there are advantages. When you register for income tax, you can declare your income, but also your losses. And I will cover that later. Losses are a big one and they work to your advantage. So hopefully this will cover that. This is the good, the bad, the ugly of registering for income tax. So it's fairly obvious. The good is, you know, if you're at a mart and you want to sell your honey, you don't need to be nervous about the person walking up to you. You don't need to worry, God, are they from Revenue? Are they going to catch me out here? Because you're registered, you're fine. You don't need to worry about it. Then Steve has informed me beekeeping is not a cheap hobby or business. So if you're registered, you can start writing off every single expense that you put through that's beekeeping orientated against your income, and it all comes off at the very end. So it'll reduce your taxable income. PRSI. Now, I try not to cover PRSI too much because PRSI is a very complicated area. But you know yourself, you need to contribute into PRSI in order to get your state pension. So just by doing beekeeping, you can do the minimum contribution if you had a loss. And if you pay in 500 euros, that basically goes towards your state pension. And it could mean the difference between you getting your state pension and you not getting your state pension. You'd insure your car for more than 500 euros and you may never need it. You're going to need your state pension. You can actually contact social welfare if you're ever in doubt about your contributions to date, and they will lay it out and they will let you know if there's a shortfall. And this could be your opportunity now to catch up and ensure you get that pension. At the end of the day, like I said, you pay your car insurance, you don't question it. So why wouldn't you pay into your PRSI? It'd just be madness to not pay a minimum of 500 euros to ensure your 235 euros a week. So then we have the bad bit about being registered. Not bad for me because this is my trade, I enjoy it, but you know, you have to keep your records. You have to keep your records for 7 years. You need to detail every bit of money you took in, all your expenditure. You have to file your annual tax returns or go to an accountant or a tax agent and have them do it. And like I said, there's that minimum PRSI contribution. But it's not always mandatory, but I always say to my own clients, I recommend it. Again, like I said, 500 euros, very, very, very small price to pay for what you get in return. And then the ugly is when you're not registered. This is not anything any of you want to experience. If revenue catch you out, you will be subjected to a revenue audit. I've hosted many in my office, and I felt so incredibly bad for any of my clients that perhaps didn't declare something or knowingly didn't declare something, and the grilling they got was just unbelievable. Revenue delve into areas of your life that you just never knew they'd be interested in. And revenue, they're smart. They're on social media now. They catch people out by people flogging their wares on like the Facebook shops, the advertisements on the super value wall. They can catch you out anyway. So this is just like a serious downside to not being registered. You know, you're going to live in a constant state of paranoia, and it's not worth it. And you'll see that later on the slides. It's not worth it. Then obviously now, being listed as a tax evader, that'd be for very large sums. So I wouldn't worry too much, but I do have to point it out. But there are penalties. And if you had a liability, the interest it's a whopper. It can build up so much. So that's the good, the bad, the ugly. Excuse my, I think it's a Clint Eastwood reference. So these are the revenue penalties. And by the way, if any of you are finding that my face is in the way, literally drag and drop me and Steve, and we will get out of the way of the content. But I'm not going to dilly-dally on this too long. Like I said, Steve is going to release a recording of this, but these are the revenue penalties and the percentages. And generally, the flat rate is always going to be 4,000 euros. And these percentages are extras on top, unless you were caught and you make what is called a qualifying disclosure. And that is if you're informed of a revenue audit and you decide, God, I better go through my books and records, you realize unknowingly that you made a mistake, you can declare that mistake, declare the tax you owe, and that is classed as a qualifying disclosure. And that may actually pardon you from a lot of these penalties. So I'll move on from this. Like I said, this is all available on revenue, and Steve will release this as a recording. Okay, so I'm just going to have to move my own face here. So how much do you have to earn? So another common thing is people are confused over what is taxable earnings. And as I have here, it is not your sales. So if you make 10,000 euro sales in a year, that's not what is taxed, because you're registered now. Now you get to claim your allowable overheads and your expenditure, your capital allowances, which I'll cover. That's on the vehicles, a beehive. I'm trying to think of other really common ones, but generally vehicles, beehives, anything that you could sell on to somebody else will be classed as a capital expenditure. And then obviously you get to pay for your medical expenses, so you can get 20% on that. So it used to be 40, but as with everything, you know, don't we get less? So depending on your circumstances and provided you've no other income, you would have to earn a taxable income, not your turnover, of 16,501 euros in order to start paying a cent of tax. And it's depending, like I said, on your circumstances, if you're single, if you're married, jointly assessed, but that's based on if you were a single person on your own credits, and that's pretty much it. So here you go. This is again available online. These are the rates that you can earn up to at the lower rate, and then obviously the balance goes in at the higher 40% rate. But again, chatting to Steve, I don't know if any of you will be going into the territory of the 40%. I mean, I'm sure you would love to be in the territory of going into the 40% in the sense of what a great year that we made such a huge profit. But no, let's assume you're all going to be at the 20%. So they are the cutoffs, and then anything over that is taxed at 40. Again, PRSI, when you're self-employed, your PRSI rate is a flat rate of 4%, and that's regardless. That's even if you made a taxable profit of €1, you're going to pay 4% PRSI into that. And that, again, goes towards your state pension and everything else that everyone is entitled to. And now rules have changed. Leo Varadkar came in years ago, and he's trying to balance up the way PAYE workers and self-employed workers are. Basically, in the past, self-employed got nothing. You know, if you lost your income, you hadn't a leg to stand on, you had nothing. You really had to just go and find a job. Whereas now we're more in line with PAYE workers. You're entitled to other benefits. You're entitled to job seekers allowance. You're entitled to illness benefits. So, you know, try to think of it in the back of your head that you're kind of paying. It's like an insurance policy. So there are definite benefits to paying into your PRSI aside from your pension, but we won't dwell on that. You're all still whippersnappers. So these are the very basics of your tax, getting it going. So as with the process of VAT registration, which I'll cover later, you can register for income tax on revenue.ie or ross.ie, and you follow the steps when you go in to do that, and I have a video tutorial later, again, all available online, very, very, very straightforward, and takes a matter of days to get you up and running and registered. This is an interesting one. Steve was very fond of this one here. Normally, you will see in point 3 there, you would file a form 11. That's your income tax return if you're self-employed. But there's a little twist here. If you work mainly, if that is your main source of income, your PAYE employment, and you do your beekeeping on the side, you do it on the weekends, and it's fairly small, although I have to argue that a profit of €5,000 is not bad for a side hustle, something that you love to do. You don't need to fill in a Form 11 or register for income tax, but you do have to form what is called a Form 12. And I think it's now available online. Traditionally, it was very old school. It was paper. It was pages and pages and pages of documents. But Revenue, they're starting to roll with the times now. So there is a Form 12 available to file. Other than that, you file what is called the Form 11. That is definitely on Ross. Very self-explanatory now. You know, you work your way through it. You fill in the boxes, and Revenue will calculate your liability for you. But it is worth knowing how to calculate it yourself, because you could have filled in something wrong, you didn't realize it, and you've just gone ahead and gone with what Revenue have calculated. So always worthwhile kind of just making an exercise for yourself, having a go doing it. And you could also download what is called the Ross offline application. This is basically where you can, it's not being submitted to Revenue, but you can put in figures, you can play around with the calculations, and you can see for yourself. And if you were happy with what you came up with, you can then upload that to Revenue. So that's actually a really good exercise. I should have put that in the slides. I recommend the Form 11 on the Ross offline application to everyone. It's really, really good to kind of get your head around how this works without actually submitting it. Now, this is what is allowable. So there's a lot you can actually claim. There's a lot more than you can claim that I could tell you, because I'm not a beekeeper. I don't have a clue. It's such a complex trade. I saw a list that Steve showed me, and I can't even pronounce half the things. So there is so much you can claim as a deductible expense. And you know yourself, this isn't a very, very expensive hobby. So to be able to claim this, it's just golden. I don't understand why you wouldn't be doing it, because when I show you later the benefits of it when you're making a loss, it'll just click. It'll make sense to you all. So obviously you can, anything that you buy for resale, which I don't know would directly apply unless you're buying your bees to sell them on. Materials related to the supplies of goods and services. So that's as long as my arm, all the materials you need. Your rent and your bills for your business premises that you keep your bees on, that can be claimed. Running costs for your vehicles, your machines, everything like that. Professional fees such as accountants, legal, and then if you took out a loan, you can claim the interest on that as a deduction against your income. And then your regular things, your print, your postage, your stationery, if you're buying labels, I'm just trying to think, anything really like that, you know, it's huge. Like I said, the list is as long as my arm. Now, there are specifically disallowable, Revenue is very strict on this. There is no sway on this at all. They have it stated on their website in bold writing that you cannot claim these as business expenses. So you can see here there's clothing, but obviously all your safety gear, you know, your bee suits, safety boots, anything safety, you can put that through and stand over what you're saying as well. Don't worry about it. As long as you can say to revenue, it was a requirement for clothing, that's fine. Food, again, you know, when you're nipping down to the garage to get your chicken fillet roll because you're hungry, doing all your hard work, you cannot claim that. You can put it through, but you have to take it back out again before you submit your tax return. Business entertainment expenses, I argue this one all the time, actually. I don't quite understand this one because let me give you an example. Okay, so I want to win a big contract with the client and I know I've got to take him out and wine him and dine him. And eventually it's going to get me the contract and it's going to really further my business. But I'm not allowed to actually claim the money that I spent on that client, which doesn't make sense. But if you have employees and you take them out for pints once a month for a big party, that's allowable. You're allowed to spend all the money in the world on entertaining your staff, but not your prospective clients or your clients. And then assets purchased, when you buy your van, you can't just write it out flat in your accounts. This has to be done via capital allowances, which I'll explain on the next slide here. So capital allowances are expenditure and, like I said, capital items. And sometimes people find it difficult to differentiate what is a capital item. And I always try to just say to them, it's something that you can buy, you can use, has a long life, and you could potentially sell on. You're not going to buy your pens and your paper and sell them on to anybody. They're useless. They're just the day-to-day overhead. You can put that through. But the common ones are plant and machinery, fixtures and fittings, like your hives, motor vehicles, and computer software. That should actually just say computers. I would generally put software through, your antivirus, your subscriptions. They would be overheads. But if it's a big investment in some kind of software, it's kind of a gray area. You probably want to see clarification on an accountant on this matter. But I can't imagine you'd be paying out more than just your monthly fees for, you know, your McAfee, all that. So the rule is that you write it off at 12.5% a year, which is the equivalent to writing off your asset over 8 years. Perhaps that's fine for motor vehicles. You will probably get 8 years out of your car. Unfortunately, the same applies to your computer equipment. You show me a laptop that will last 8 years, but this is one of those anomalies at revenue. They set the rules. We can't go against it. There are rules if your laptop dies and it's scrapped or it's sold, whereby you can kind of recoup what you didn't get to claim. It's too much for me to try to go into tonight, but again, an accountant would do this for you automatically. You could read up on it, but it's called a balancing allowance or balancing charge, and you can claim that as relief. So like I said, your asset must be in use at the end of your financial year to claim this expenditure. So if your financial year, you pick your financial year when you register for tax. Most people keep it 31st December, nice and clean calendar year. But the asset must be in use. So if you buy the asset on the 30th of December, absolutely fine. You can claim that off. You can have the full year's capital allowance for that, even if it was only in use for 2 days of the year. So that's just an important point. It has to be in use. If you get rid of your asset in July, you've lost the benefit of the capital allowance for it for that year. And then obviously, if you were making a loss, you have no capital allowances to claim. You've nothing to put the capital allowances to. So you can carry that forward to the next year or the next year or the next year. They just keep carrying on. So it'll always reduce your assessable profit. This is the one that, again, Steve loves this. Trade losses, making your losses work for you. This is something people don't seem to realize is, this is when your losses are winning for you. You know, if you're making a loss now anyway, doing what you do, why not claim it as a loss? And then potentially when you're starting to really make like a lot of money in the future, this is where your trade losses are really, really, really going to come and play a blinder for you and cut down on your tax bill in the future. So like I said, if a loss occurs in a year that is taxable, your taxable profit for that year is deemed as zero. So you won't get money back from revenue for making a loss, but you won't be taxing anything because they deem it that you've made nothing, absolutely nothing. But they're not lost because these losses can be used. You have 3 options. You can offset them against income from other trades in the year of loss. So if you make a loss in 2021 from your beekeeping, but you happen to have another trade in 2021 that made a profit, you can offset your beekeeping loss towards your profit of your other trade, and you can reduce your taxable profit and your income tax bill potentially substantially. You can carry back your loss and offset them against the previous year profit from the same trade. This is when it has to go against your beekeeping. So if you made a profit in your beekeeping in 2020 and you declared it and you paid your tax, you can now carry that loss back from 2021 and you can have a review of your tax and you can get a tax refund. Always good. And then the other thing is, and this would be the most common, this is what everyone would tend to do, they would carry the losses forward. So, you know, it doesn't get lost, it just goes in a memo. So you always keep a tally of your loss and just keep it running forward. It's not, there's no cutoff anymore on the years that you can carry your loss forward, but you have to keep the record. Revenue are not going to remind you. They're not going to pick up the phone and go, oh, Bob, you made a loss last year and you forgot to offset it. They will never do that. So this is where you have to really, really, really get into your business, understand the way it rolls, understand your losses, and just keep records. As much as you hate them, keep them. If they're on the back of a cigarette box, I don't care, but do not lose records of your losses. This is how I keep loss memos in my office for my clients. So I've kept, now obviously I've assumed they're rather large losses, but like let's go with the extreme for everything. So you can see here in the top box, this is where I've been keeping, this would be where I am recording what my client is declaring to revenue. So you can see that in 2020, they lost 9,000. So their assessable profit for tax was nothing. 2021 was 4,500 loss, so nothing. And then 6,000 euros loss in 2022. So again, nothing to be taxed in 2022. They then came along and they made 7,500 euros profit in 2023. So that is an assessable profit of 7,500. However, this is where we keep the rolling loss memo in the box beneath it. So you can see I've carried down the loss for each year. I've kept a running cumulative loss balance on the right-hand side of the box. And this is where in 2023, I've used 7,500 of that cumulative loss, and we still have another 12,000 euros loss to carry forward to the next year, where hopefully, again, you'll make a profit and that loss will step in. So it's so useful. And like I said, revenue are not going to tell you, even if you record your loss forward on your income tax return, and you come along the next year and you've just completely forgotten that you had a loss, they're not going to bring you to tell you. Absolutely not. Not out of malice or meanness or anything like that. It's just, this is all done by a machine. It'll only ever be flagged up to revenue for something that, you know, will cause a human to actually look at it. But generally, this is a machine. This machine doesn't care who has filed the return. It just wants to see, do they owe us money? If they do, we're going to generate that letter, because they've no problem sending you the letters, as some of you may hopefully never have realized. So that's your losses. So that's really, really important. So like I said, Steve is recording this. You can do a screen grab, anything, but don't worry about topping this down. This will all be available to you. So just get in the habit of writing down your losses each year. Use those losses. Keeping records. Now, this is a very simplified Excel spreadsheet that I would recommend people to keep. You know, you don't need to invest in accounting softwares. Of course you can, but I don't think it's necessary. You know, unless you're taking in hundreds of pieces of paper in the form of expenses every year, I think just keep a single Excel spreadsheet per year. Jot down a folio number on each item and just record it here in your spreadsheet. So you do have to keep these for 7 years. If revenue audits you, they do expect to see not only a summary or an analysis, but they will also want to see the hard copies of these receipts. Some people do keep them digitally, and I think revenue are changing their rules now whereby they can access them digitally. In the past, they had to be printed out for them, which was kind of ridiculous. But I think now this is one of the benefits of COVID. Revenue have just done a full 180 now. They've embraced the digital age. They appreciate the fact that you don't want to have folders and folders of paper around. So if you upload it to another device, keep them there, but make sure they're accessible by Revenue if they do request them. So at the top here, I'm literally just keeping a record of the purchases, and yours is going to be much more complex than this. This would be my dream client, only have 5 invoices in a year. So what I would recommend is mark them down, date them, what is it for, your filing reference that you're going to scribble on your receipt, the total amount, and then if you're VAT registered, put the net into whichever analysis column you want. So whether it be motor, your beekeeping materials, your workwear, and then your VAT at the end. And obviously, if you're not going to be VAT registered and you spend 50 euros on diesel, it's 50 euros going under motor, not 41. You claim the full amount. And then at the bottom here is your sales records. So you may not issue invoices to people, and that's fine, but you do still need to keep some kind of a record of your sales. Even if you're at a market on Saturday, just jot down what you took for the day. In an ideal world, you'd be lodging it into your bank account and Revenue be seeing it, but they can't make you do that at all. So just keep some form of your sales. And I'd actually just like to bring this up. If you are issuing any form of paper to, say you sell to a local shop and they really want to buy your honey, and you go in and they just say, listen, can you scribble down an invoice, because they need to keep their records, and they're certainly going to be claiming, anything they buy from you as an expense. And this is how a lot of people actually end up being audited. And it's through the strangest thing, whereby Revenue may happen to be auditing the shop that they sold the honey to. And in the process of audit, Revenue just happened to stumble across a little piece of paper from Mr. Joe Blogs, who sells honey, and then they get inquisitive. They're like, well, who is this man? We don't know who he is. And the shopkeeper is not going to protect you, because they're sweating into their t-shirt. They don't want to be, told that this is a fake invoice and they don't get to claim it. So they will hand over your information, and that's when you get the letter or the knock on your door. Not so much now with COVID, but you will definitely get contacted by Revenue because they want to go deeper. So this is how a lot of audits happen. It's an accidental, just they fall across an invoice or a scrap of paper from you. So just keep that in mind. Like I said, my job is not to force you to do anything. It's certainly not to force you to register for income tax. Makes no difference to my life, but just be aware. I think if you're armed with knowledge, it just helps you make better decisions, and you know what you're getting into then. So this is VAT. Most of you probably won't be registered for VAT, but there are definitely advantages to being registered for VAT. So as you can see, it's unique. It's across all of the EU states. It's what I refer to as a chain reaction tax. It's one of the few taxes that changes. It grows and grows as it passes along the chain from the supplier down to the main customer. It grows and grows and grows, because that's the nature of business. You're going to sell on everything at higher amounts, and you have to tag on your VAT as well. So the person who foots the bill is the non-taxable person. So if you are not VAT registered, you're essentially the final customer. You pay the full whack of the VAT to the last person in the chain, and it's you that foots the bill. So I have it there. It's an indirect tax. It evolves and increases as it moves through the transactional supply chain. It's very handy nowadays. You're probably having issues with Brexit. You're having to go further afield, or even up to Northern Ireland to get your equipment. And if you are VAT registered and you can provide an Irish VAT reg to a business in Northern Ireland or the rest of Europe, they actually will not charge you VAT. So that's a great incentive, because if you're just a non-VAT registered individual, they will charge you foreign VAT, and it can be pricey, and at the end of the day, you want to try to get things for as little as you can. So I'll talk you through. There are definitely advantages to registering for VAT. So these are the VAT thresholds, and this would be your turnover. This would be your sales. So it would apply to you, the 75,000 one, because it's mainly products. I can't imagine many of you only operate in a service capacity where it would be 37.5. So 75,500 is the threshold in Ireland. Once you go over that, you are legally obliged to register for VAT. It's not a choice anymore. You have to register. So can you elect to register for VAT? So if your sales are less than 75k, you can absolutely 100% register for VAT. There's no requirement to be above the threshold. There are implications if you elect to register for VAT, should you decide down the line that you want to cancel the registration. And I will talk you through it. And it literally only applies to those of us who have elected to register, not the people who had to legally register. So there are pros and cons. There's pros and cons to every tax. Obviously, the pros are that you pay no VAT on the sales of your honey, as it's zero rated supplies of goods. So this one of these really cool things in Ireland where revenue recognised certain things shouldn't have VAT on them. Honey is not a luxury. It should never have VAT on them. You don't pay VAT on your sliced pan or your vegetables or your fruit. Why should honey be different? So that's great. That means you can make sales and you don't have to charge VAT to your customers, which means you don't have to pay over VAT to revenue every time you make a sale, which is super. You can reclaim VAT on your outlays, including your hives, your jars, your fuel, exceptions. You're not allowed to claim back on your petrol, but yes, to your diesel, and other qualifying overheads. Everything, you know, that you buy for like office needs, it all has VAT on it. So you can start claiming all of that back. So just picture it. You're selling nothing but honey. It's a 0% sale. You're buying in so many props, so many items, so many overheads. They all have VAT on them. So you're going to end up in a situation where you're actually looking for a tax refund every 2 months. It's golden. It's money into your bank account every 2 months for those expenses that you had to foot. And in this day and age, we all need a bit of help. So it's a really good thing to consider. But obviously, the cons will show you maybe the other side of it. Like I said, no VAT charge to you from suppliers based in the EU. I'm sure a lot of you have to go into Northern Ireland or other parts of Europe for equipment because we're a lovely little country, but unfortunately lacking in many things that we need to get. So the rest of the United Kingdom's the question for you now wouldn't even go there. Customs, tariffs, the VAT on the customs, absolute headache. So if you can, look the rest of Europe. I mean, it's there for us, and so just get researching. And the best thing is they're all English speaking. It's only us that don't really seem to learn their language, but they're so helpful. They're there for you. And the Northern Ireland Protocol was the best thing that ever happened to us and to Northern Ireland, because we can still trade with them as if they're part of the EU. They have a special exception. So then the cons of registering for VAT, they're fairly obvious. You have to file VAT returns. That's just one other thing to add to your to-do list. And you do have to file your VAT returns. Even if you don't make a sale or make a purchase, get your VAT return filed. Just file your 0 VAT return, because revenue do not take kindly to people not filing returns. Even if you can't pay it, if you had a bill, get it filed, and then you open up the doors to communicate revenue over a bill. But like I said, I can't see you ever having to pay VAT if you register, because honey is 0%. I cannot see that changing. If it changed, I'd be incredibly surprised. So you'll always be in a refund in my mind if you register for VAT. There are, like I said, there is VAT on the sale of bees. That's about it. And it's at the lower, it's at 4.8%. But still, your overheads are going to be in at 13.5% and 23%. So you'd want to be selling an awful lot of bees in order to be in a situation where you have a liability. And another thing is VAT is tricky. It's not as straightforward as people think. People see the word VAT on a receipt and they just automatically think, oh, I can claim that. But it's not the case at all. You go to the petrol station tomorrow, get your unleaded fuel. You will be given a receipt that will show there's VAT of 23%. And maybe you went and you got a coffee and then you got a can of Coke and you got a sandwich, and there's VAT and all of those, but you actually are not allowed to claim them. They're not there for you. So unless you're buying that breakfast roll to sell to somebody, you've no business claiming the VAT on that. So I kind of wish they would change the rules in Ireland regarding handing out receipts to people in a garage, because you've not gone to the garage to buy unleaded fuel to sell to somebody else. So just be aware that there are pitfalls, and when you see the word VAT, don't assume it's there for the taking. Check everything out. Revenue's website is amazing now. You can Google every word going in the revenue search bar, and it will tell you the rules regarding the VAT on that item. So as I mentioned, and I know I keep mentioning it, the sale of your honey is 0%, zero rated. Sale of candles is 23%. This is a huge bone of contention at the moment. I'll tell you at the very end, this wasn't always the case that every candle was 23%, but now unfortunately your candles, they are 23%. So that's maybe if you're in that side of the beekeeping, maybe that's when you need to sit down and work out, like, how much am I selling? Is it worth it? Will my VAT on my sales exceed the VAT on my expenses? And then the sale of bees is 4.8%, referred to as flat rate or farmer's rate. And like I said, VAT rates change all the time. If you had Googled last year the sale of candles, it would have told you if it was white and it was cylindrical, it was 0. That's gone now. Your candles are 23%. So just always keep abreast of everything. Revenue have a really indexed, deep index of all the VAT rates and everything going. There are things in there you didn't even know existed, and the VAT rate is there. Or if you can't find it, contact Revenue and they will get back to you. Could take a while, but they will. This is now, my lovely assistant Steve did this. This is Steve's exercise of how much does he understand VAT after me lecturing him for the past 6 months. So Steve put this together. I could never have done this. So every bit of credit in this goes to Steve, because I can barely pronounce some of the things in this. But he's just trying to demonstrate to you what you can claim in VAT on the basic sort of things that every one of you has to buy in a year. So he's listed down here all the items, the cost, the VAT rate applicable to them, and is that VAT recoverable, with the very obvious green and the Y. And at the bottom he has the sugar, the retail, it's not, so obviously there's nothing to claim on that. Your insurance is a VAT exempt activity. You will never be billed VAT on insurance anyway, so there's nothing there. And then he has down here the other side of it. Your accountant will always charge you VAT. Your phone bill always has VAT at 23%. Your broadband, your electricity, if you're claiming a portion of your electricity, if you're powering something or even running your office, you can claim a proportion of that, and you can claim a proportion of that 13.5% VAT rate as well. Your petrol, you see, Steve, you've learned so much. He even has it in a big red there, that even though there's VAT on the receipt, you cannot recover that. Diesel, absolutely, go for it. Your car maintenance, when you go to the garage, your NCTs, they all have VAT and you can claim that. Your mortgage and your rent isn't always exempt, actually. Sometimes your landlord will be VAT registered. I can't imagine a scenario when you would be renting somewhere that would have VAT in it, but not to say it's not going to happen. So if your landlord puts VAT on that invoice, you can claim that VAT back if it's for your trade, just your trade. And so Steve has down here that the total spend in the beekeeping was 1,548. That's just for your basics. And the VAT in that you can reclaim is €254.17. Now I know you're thinking that's probably not a lot of money to go to the trouble of filing VAT returns, and absolutely fair enough. If that's how you deem it, then that's your stance on it. But I would see that as that's money for you, and the sky's the limit on what you can spend, I'm sure. And then you've got all your accountancy, your phone, your electricity on top of that. So take it or leave it, it's there. But that's real. And Steve, proud of you, did a great job on that. So let's get on to more pressing things about cancelling your VAT registration. This, again, like I said, this is only applicable if you decided down the line, you elected to register VAT, you're absolutely sick and tired of trying to keep on top of these VAT returns, they're annoying you, or for whatever reason you decide you have to cancel, this is the only time I say beware of electing to register, because revenue, they're not going to take kindly to that. They do not like to hand out money to somebody who's then just going to go, no, you know what, I don't want to be VAT registered. So there is a calculation to see, do you have to pay them back, which is never good. So it's over here on the side. You have to pay them back any excess of VAT refunded to you over the tax paid during a review period, which is either the taxable periods during which the election had effect, or 3 years prior to the date of cancellation, whichever is the lesser. So if you had been claiming it for 5 years, they're obviously going to go for the 3-year option because that's the lesser. And if you've been claiming it for 1.5 years, they're just going to look at that 1.5 years. So they literally calculate it here in this lovely little formula. So, you know, the VAT repaid to you in the review period plus any VAT you deducted through your intercommunity acquisition, basically VAT that you should have paid, and the net total of VAT paid to you by the review period. So I always say to people, you know, consider this when you're going to elect to register. Are you going to keep it up? And if you don't have anything going on in a period, I would always just perhaps say, just keep up your VAT registration and just file your nil returns and just keep on going. And you know, you may get back to a stage where you will have VAT going through the business, so you will need that VAT registration. And I know it's quite morbid, but I should add that if you elected to register for VAT and touch wood, you passed away, there is no calculation on any VAT to be repaid. This is exclusively, you know, this is expressed by revenue. They will never come to somebody who's just lost their VAT registered partner and say, right, we need to do a VAT calculation now. That's not going to happen. If somebody passes away, that's it. It's done. It's gone. The person dies, the debt dies. End of story. So just, I know some people do think about that. They like to think about what's going to happen when my family get in trouble. So don't ever worry about anything like that. And that's the last I'll touch on, the morbid side.
Deirdre, I have to say personally, it's been a pleasure working with you on this. And I'm sure that there's a million thanks here coming in from people, that a lot of people are super, super, super thankful that you've given your time for this. Deirdre has not been charging for this or anything like that. She's just done this to help us out. So thank you so much. And if you need advice on your tax, you should contact this lady. She is super sound. And she does paid days training. She does loads of cool stuff. So you should definitely check her out if you have questions. And I hope you do. So calling it right now, I'm going to say this is over. And thanks to everybody who joined. And good night.
Good night. Thank you for staying awake, I hope.
Thanks, guys. All the best.
Bye. Bye.